ETFs recently have become a common talk amongst investors after a recent event in India. On June 4th, 2024, the election results were getting declared in India. There was a time during the day when the market was reacting extremely negatively to a possibility that the government would not get re-elected. Just see here how Nifty 50 was down by close to 2000 points, and it was a brilliant opportunity to add some stocks to my portfolio, I thought. So my first response to this fall was buying the dip of Nifty 50 via index funds and mutual funds of my choice. But what happened that day was a missed opportunity I felt from at least a tactical point of view. Sadly, many investors, including myself, did not get an NAV of that day even though we invested before the same day NAV cutoff time. That was the day I realized the benefit of diversifying and investing in Nifty via ETFs. Check out the price of ETFs, how low they went during the time frame when Nifty was actually down 2000 points. So why ETFs now? Because ETFs can kind of guarantee the execution, meaning if there is a buyer and a matching seller, most likely our order will go through and there is an immediate feedback. You will know then and there whether your order has got executed or not, unlike in case of a mutual fund. Remember, this is not an investment advice but an educational video. Please do your due diligence and risk analysis before investing. Thank you for watching.